All right, welcome everyone. Thank you so much for coming out on a rainy Thursday evening. We are delighted to see so many students. My name is Caroline Bruckner and I'm a professor at Kogod. I'm also the managing director of the Kogod Tax Policy Center. My job is to teach tax and also to facilitate understanding of what tax policy is and why it matters. I came to Kogod after working on tax issues in private practice for a big law firm and a Big Four accounting firm, and then served as the chief counsel for the U.S. Senate Committee on Small Business and Entrepreneurship. At Kogod, I teach tax and business law, and I also work on tax policy research that is specific to small businesses and entrepreneurs. We at the Kogod Tax Policy Center are hosting this event tonight because, as I am sure many of you have heard, Congress is considering moving forward with tax reform for the first time in more than 30 years. In fact, tax reform is a major priority of the Trump administration and the Republicans who control Congress. This kind of legislative undertaking, if successful, will have significant implications across our economy and in every single American household. But we wanted to organize this event to get behind the headlines and talk about why tax reform matters specifically for millennials, meaning you. Tax issues are hard to understand without context, and taxes matter. They are, in the words of Oliver Wendell Holmes, the price we pay for a civilized society. Tax policy represents our values and political judgment. Tax issues matter and arise whether you're at the ballot box or in the boardroom. Our job is to provide some context on tax reform for you tonight and to explain how it could impact you as a student, a young entrepreneur, or your ability to save for retirement or write off your student loans. These are all very real issues that will be impacted if Congress fundamentally changes the way we levy and collect federal income taxes. Now, tax issues cut across party lines and this campus. To that end, we've worked with our colleagues at SPA and WCL to develop this event. Because whether you're in business school, law school, or studying public policy, if tax reform does pass, it will impact you personally and professionally. I would like to thank Ben Leff and Jonathan Grossberg at WCL and Carmen Flink at SPA for helping us to develop this event. In addition, I would like to very much thank our panelists who have joined us this evening to share their insight and expertise on tax reform and how it could impact millennials. Our intent, when we were developing this event, we very much wanted to recruit alumni who are actually invested in working on tax issues to serve on this panel. Our intent is to highlight the range of professional possibilities available to folks who are interested in tax. To that end, we wanted to specifically include a networking portion for the end of the event so that those of you who are interested can speak with our panelists about their professional path since graduating AU. It is no easy feat to get to Kogod from Capitol Hill and on a rainy Thursday when Congress is in session, so thank you very much for making the trek to be with us tonight. I'd like to make one program change announcement. Unfortunately, one of our panelists, Nita Asher, could not join us tonight. Nita works with the nonpartisan Congressional Joint Committee on Taxation and is an international tax expert. She had to cancel tonight because she is meeting with the director of the Center for Tax Policy for the OECD to discuss current proposals for the international tax reform plan that the Republicans are developing. In her place, she sent her colleague, Jeff, who is a colleague on the committee and a tax expert on small business issues. So I have a lot of questions for you. In terms of how we are going to move forward tonight with the discussion, what I thought we would do is go down the line so that each panelist could introduce themselves, what they do, and talk a little bit about their professional path since graduating AU, except Jeff. But first, I wanted to go ahead, before we introduce our panelists or let them introduce themselves, I wanted to give a quick state of play of what's going on with tax reform, because although I know every single one of you is watching the tax news as diligently as I am, just for that odd person in the room who is not, I thought I would give you a quick catch-up as to what's going on. So last month, the Big Six, which is a group of policymakers, Republican policymakers, including Treasury Secretary Mnuchin, the director of the National Council of Economic Advisors, Gary Cohn, who's a Kogod graduate, and House Speaker Paul Ryan, Senate Majority Leader Mitch McConnell, Ways and Means Committee Chair Kevin Brady, and the Senate Finance Committee Chair Orrin Hatch released a tax framework that articulates basic principles for how they envision reforming the US tax code. And some of the principles that they articulated in this framework include tax cuts for the middle class and businesses, simplifying the tax filing process, ending tax incentives to move businesses and jobs overseas, and closing tax loopholes. Now, the process has moved to the Congressional Tax Writing Committees, the Senate Finance Committee and the House Ways and Means Committees, who will hold hearings and develop legislation to implement the framework principles. Other congressional committees will have input in the process, including the House and Senate Budget Committees, who are working to develop a budget that would allow tax reform to pass in the Senate under a reconciliation process, which would mean that only 51 votes would be needed to pass tax reform in the Senate. And the Joint Committee on Tax will be advising members on the economic and budgetary impact of the legislation. We are very fortunate tonight in that we have representatives from a number of these committees who have either currently been working on those committees or who are formerly have been working on those committees to share their insight and expertise on how the process is going to move forward. So with that in mind, let's kick things off with Jeff, who's going to talk about who he works for and his path to tax.
Hi. Thank you for having me, even though I did not attend American. My name is Jeff Arbeit. I work for the Nonpartisan Joint Committee on Taxation. We are basically the staff, the nonpartisan staff that works for any member, any senator and any member, any representative may ask us for help. We do most of our work for the committees of jurisdiction, so Ways and Means and the Senate Finance Committee. And I do mostly general domestic business, so corporate, some partnership, real estate, small business. I've been on the staff for 2 years. Before that, I was at a big law firm in New York. Before that, I got an LLM in tax. And before that, I was a law clerk at the U.S. Tax Court. Oh, and I should say, Aruna is going to say the same thing. Everything I say is personal. There's some magic words, but nothing I say represents my boss or any member or the chairman, etc. So thank you.
Awesome.
Let me go ahead and get that one. Just want to go ahead and clear this up. The views that I'll state here are mine and my own. I don't speak on behalf of the Ways and Means Committee or the Democratic members of the committee. So I just want to go ahead and clear that up, and I believe Jeff feels the same way. So, with respect to the Joint Committee on Taxation. So, thank you guys very much for inviting me to join. It's really nice to be back here. I am a Washington College of Law graduate, 2007. I was in the nighttime program. I decided to get a law degree after realizing I definitely didn't want to do international trade policy, and I realized I really wanted to do tax policy. And in talking to my mentor and my then boss, he's like, "You really should go get a JD." So I was like, "Okay." So I worked full time on the committee. I started working at Ways and Means 2001. I worked in a personal office for a year and a half just before that for the ranking member of the Ways and Means Committee, the then ranking member, Charlie Rangel, New York City. And so started law school in 2003. It was nighttime school is hard. It is just a long day. Every day is a long day for 4 years. But loved the education, loved the faculty here. It's a unique experience working full time in an area where you're already being exposed to a number of legislative aspects of the law. And yeah, so since then, been served on the committee in the minority, in the majority, back in the minority again. You can imagine which one's more fun. But this has been a sort of a unique year. I would say the committee has been rather focused on the concept of tax reform since about 2011, when then Chairman Dave Camp took over after taking over the Republicans at the majority in 2010 election. And there was a draft. Chairman Camp worked diligently. I think the number is 36 hearings overall over a period of about just over 3 years. and put out a comprehensive draft, the Tax Reform Act of 2014. Unfortunately, the draft was greeted with, we'll just go with like a thud. I think the speaker, and asked to respond to it, then Speaker Boehner responded, blah, blah, blah. That was his commentary on the opus that came out of the committee. So, you kind of, there was a lot of sort of difficult choices made in that draft, and you kind of know what it takes to do what a lot of people say they intend to do. So hit fast forward. We are now in 2017. You have unified control of government. And unfortunately, that doesn't seem like things have gotten a lot easier. I've always said that tax reform would be no fewer than 1,000 times more difficult than healthcare reform, and they couldn't get healthcare reform across the finish line. So I think right now we are at 29, 28 legislative days left in the year. But we can go a little bit more into process and everything after. My portfolio is very broad, really touches a little bit on everything. We are a lean operation in the minority, so you end up being responsible for a vast number of things. Right now, my main focus is disaster tax legislation. So that's what's keeping me busy in the day-to-day, along with the backdrop of preparing for the markup, the big M. So thank you again.
Jen.
All right. So hi, I'm Jen Brown. I might actually trump everyone here on how many degrees I have from American. I started or finished my MS in Law and Society, so I'm a data nerd, which makes me really unique when I tell you next what I have from. I have a law degree from WCL, and then I have a LLM in tax from Georgetown. I got all of those degrees while working full-time. Most of my work was spent in law firms. Then I started law school and hustled and ended up working for AARP and then the Department of Labor, where I worked on the Affordable Care Act. And I also worked on the fiduciary rule, which a lot of you might not know about in this room, but it basically concerns retirement fees and how much you pay in retirement fees. I left there in 2015 to go to a nonpartisan or bipartisan think tank that specializes in retirement. And I then joined American here as a tax policy fellow last year. And I focus on retirement pretty much exclusively, but a lot of my scholarship has recently focused on the on-demand economy. But I am rare because I'm probably one of 2 tax attorneys that also do data. So I actually know how to go and get the data from IRS and look at it, analyze it, figure out, how many people, when you actually write the law, how many people are actually utilizing it? What is the effective rate of something like the federal savers credit or any other credit that we're putting out there? What actually happens when these people over here make laws? And so I spent a lot of time thinking and writing about that.
Awesome. Alex?
Okay, well, my name is Alex Brousseau. I have 2 fewer degrees from American. I did the Master's in Tax program. I see Don Williamson is here tonight, great guy. I also did that in the evening while working. So I am a CPA, and I did this program while I was in tax practice at Deloitte out in Tyson's Corner. I did that for about 6 years. Mainly in the real estate financial services area, so hedge funds and REITs and things like that. I transitioned to Capitol Hill and was there for about 4 years. And fun fact about me, I'm from North Dakota. I'm probably the only person you've ever met from North Dakota. There's only 600,000 of us. And the tax position on the Senate Budget Committee became open under the former chairman of the Budget Committee. His name is Kent Conrad. It's kind of the consummate red state Democrat, very much a thing of the past. It doesn't really exist anymore, but he was an awesome member of Congress, chairman of the Budget Committee. He was on the Finance Committee, so he was a tax writer too. So as a CPA, that was really an interesting and fun job for me. He retired after 26 years in the Senate, and I had the opportunity to essentially reapply for my job, which I did with the next chairman, who is Patty Murray from Washington State. not on the finance committee, but a member of party leadership. And as you can imagine, the way Congress works right now, it can be better to be working for a member of leadership than a kind of a rank and file details member, because that's where the deals are ultimately cut at the end of the day. So probably the, coolest things I worked on with Murray were, one, the fiscal year 14 budget resolution. The Senate hadn't passed a budget in many, many years, and we got one through just barely in 2013. And then you remember the government shut down in 2013 in October. Well, Patty Murray cut a deal with Paul Ryan when he was House Budget Committee chairman, and I was part of that conference committee. So that was, very fun to work on that. Democrats lost the Senate in 2014, so it felt like a good time for me to move back to Deloitte. So I'm now back at Deloitte in our national tax office doing tax policy. So my day-to-day right now is a lot of travel, honestly, and talking to clients and groups about the state of play with tax reform, and talking to former colleagues on the Hill and trying to keep a finger on the pulse of where things are headed. The Budget Committee, and we'll talk more about this, oversees the reconciliation process. This is critical to Republicans' ability to get tax reform done, and it's part of the reason, as Haruna alluded to, that I've always been a lot more pessimistic about the odds of something happening than other people you might find in town. It's just not a policy or a process that's very well suited to something as sweeping as tax reform, and you did see that play out on health reform as well. But as of right now, that is still the intent, so it'll be interesting.
Great. Natalie?
Hi guys, my name is Natalie DiVincenzi. I just recently graduated from American this May. Right now I'm working as the Director of Operations for a company called Like, which is a financial management, accounting, and bookkeeping firm for nonprofits and political firms. While at American, I completed my capstone with the help of Professor Bruckner on the looming fiscal crisis and the millennial perspective. I also worked at a nonprofit dedicated to tax reform while at AU, so that's pretty much my experience, and I'm excited to be here. Thank you for having me.
Awesome. I'm excited to talk about your work because it's really interesting work and it's specific to AU, and I think it sets a good foundation for the rest of the discussion. So, Natalie, you wrote your capstone thesis on the debt and deficit, and tax reform was only a small part of that, because you also looked at budget reform and healthcare reform. But can you tell us a little bit about the current state of play of the debt and the deficit? Are they the same thing?
They are not. So right now the debt is $20 trillion, which is the biggest it's ever been. The deficit occurs when expenditures exceed revenues, and the debt is the combination of all those federal deficits. So
we have an annual deficit, and then we have the collective debt. And when we talk about tax reform, it's such a sweeping kind of idea, and one of the things that gets bandied about is how expensive it is. And one of the things that I was interested in is learning more about how that would impact the debt and the deficit. And we see that with proposals that have been, like, for example, the Trump proposal. I've seen numbers that say that it could impact our deficit up to $5 trillion. Why does that matter?
Well, it matters for a lot of reasons, and especially for millennials too. There's a few reasons. One, we have higher interest rates with a higher debt. So if you want to buy a home, or take out a mortgage, things like that, it's definitely something that impacts you, especially when we're so young and we're in those phases where we're about to graduate, or you guys are about to graduate and just start your life. It's also important because of national security. A lot of our debt is foreignly held, so that could be a pressing issue. It's very important that we make sure that the debt is manageable, not only because of the interest rates. It also helps. We also have higher income, higher wages when the debt is lower. So it's definitely an issue that needs to be fixed. And with the way that the population is aging, it's important that we address this now, because people age 64 and above are going to be growing by 39%, while people age 18 through 64 are only going to be growing by 3%. So the aging population is going to be put a lot of pressure on healthcare. It's it's going to put a lot of pressure on Social Security, which is going to be insolvent. So it's going to drive up the debt even more.
Okay, and so why that matters for tax reform is because the way that we've been talking about tax reform is that it would cut rates. That's a principle that everyone wants to pay lower taxes. I mean, I think we can all agree about that. And and why it matters and why there's a lot of discontention in many on all sides, I think, is because how it would impact by cutting those rates. That would mean that we would collect less money, and that could have an impact on our debt and deficit. But do the debt and deficit implications, and Alex, this is a question for you, do they matter for purposes of the process?
Yeah, I mean, you can get really arcane really fast, but I mean, if you have tax revenue or a tax reform plan that loses revenue, first of all, it probably can't move under reconciliation. At least over the long run, it can't increase the deficit. So procedurally, right out of the gate, you have a problem.
So the Senate rules mean that if you increase the deficit, you can't pass a bill with just 51 votes?
Right. You can do whatever you want within the 10-year budget window, and this is kind of we'll see where the budget conference goes next week and beyond, but the Senate right now is looking at a $1.5 trillion net tax cut over the next 10 years. The House has a budget that's basically calling for revenue neutral tax reform. That's fine, but then starting in year 11, you can't have a deficit increase in any fiscal year, or Democrats essentially in this position can filibuster elements of the bill.
Oh, okay. So the first step to trying to get a tax reform bill procedurally then is, from what I'm hearing, is that the House and the Senate budget committees have to have an agreement on what the overall budget is?
Yeah, that's the first step. I mean, they all they do is put out the 10-year number, and then you still have to deal with what's known as the Byrd Rule in the Senate, which sets up 60-vote hurdles to this reconciliation process, which is otherwise geared toward passing something with just a simple majority in the Senate. 50 votes in the current context because the vice president breaks ties in the Senate.
Okay, okay, I hear what you're saying. And one real quick explanation, Aruna, can you explain the differences between tax reform and just a tax cut bill? Because we have tax changes all the time. We've clearly had tax bills since 1986, the last time they reformed the code.
Sure. Before you answer, I just want to say one thing that just about this whole idea of reconciliation and these special protections. They don't matter at all in the House. A bill passes the House with a simple majority. This idea of, the birdable provisions that have a budget impact, you can raise those issues in the Senate. In the House, really don't matter at all. So imagine there are provisions that could be part of a package that in the House that passes that are critical that can be stripped out by parliamentary ruling. So real quick, tax reform versus a tax cut. I mean, the beauty of the phrase tax reform is that it literally means all things to all people. Everybody is for tax reform because at the end of the day, you can't be against it because that means you support our current state of affairs in the tax code, and everybody complains about that. So you can't be for that. Generally, tax reform has sort of been referred to as making the difficult choices to offset any rate or revenue reductions that would result from legislative changes. So it's the idea of, okay, let's say companies get a, let's just pick, for example, the Section 199. It's a deduction for domestic manufacturing, simplifying this a little bit. And that provision over the 10-year period, we'll just say it costs about $200 billion. And you've got a corporate rate at 35%. If we repeal that provision, you could finance a little bit of a rate reduction. And that to me is you've made that trade-off. You can go to 35 to 34, maybe 33.5. But now domestic manufacturers are giving up something that was special to them to pay for this rate reduction does not discriminate. So banks that didn't even take this one are still benefiting from this one. So the idea of reform is there's always the goal of not creating winners and losers, but I think you have to admit that it's inherent in any sort of major legislative package that you will create winners and losers.
Okay.
Does that work? And a tax cut, it's just a change to our tax law. That'll probably reduce revenues. That's probably the easiest way to put it.
Right.
On offset without those difficult. I call it, my analogy is the cheesecake versus spinach. One is, a balanced amount of cheesecake, a really big cheesecake with like a dump truck of spinach. What if we just took all the spinach away and said, how about a smaller piece of cheesecake? So that's sort of the tax reform in dinner form. So
what you're saying is with a lot of cheesecake, you have a huge budget impact.
that is correct. And if you want to do it in a tax reform revenue neutral way, a couple dump trucks worth of spinach.
And so all the fighting's over the spinach right now.
Nobody wants to be spinach. Nobody wants to be on the table unless you're on the cheesecake side, of
And
course.
so everything I'm hearing about and everything I read about is all about our tax rates are so high. Why is this such a problem if our tax rates are so high? Why can't we all agree? We know there'll be a debt impact, but why can't we just agree to go ahead and cut our tax rate so people can have more money to grow their businesses? Anyone want to take a shot at that?
I can actually answer that.
Go for it.
So Tax Policy Center has actually found year over year every year that this doesn't work. This actually, by lowering tax rates, it actually does not increase GDP. It does not increase growth. There is no direct correlation, is the fancy word for this, between the two. So, this is like a traditional policy argument that's been raging since like 1971, I think, might be 64. But yeah, there's always two sides of this coin, but the well-respected tax policy and econ nerds here in town have come out year over year again and says that there is no direct correlation between the two.
What do you think about that, Jeff?
So maybe it's helpful to take a step back. I mean, the reason we're here is why does tax matter? Government spends money, and so it needs to raise money somehow. There are a lot of ways you can raise money. One of them is through our income tax. I mean, you could just have sales taxes. European countries have value-added taxes that raise huge amounts of money. Less progressive. You need to make changes to make them progressive. So we have an income tax, and European countries do too, but they don't need to raise as much from them. So now we have to ask, well, how do you want, what do you want to spend money on? We spend money on a lot of things, spend money on a huge amount on healthcare, Social Security, the military, our positions, you guys pay for.
National parks, they're beautiful.
National parks. And then you kind of ask, well, okay, so how are we raising this money? Corporate tax, tax on wages, et cetera. And then there are what are called tax expenditures. If you have your basic income tax, if people have income, and you might have progressive rates, so you pay more as you earn more. You have expenditures. So Aruna mentioned one. You might want to encourage domestic manufacturing. So you might want to give domestic manufacturers a lower rate. But the result of that is that you need to raise taxes a little bit more on everyone else. And we have maybe not thousands. We have many, many provisions like that give special benefits to certain groups. And depending on what you think, and so the tax reform pitch is generally, let's sweep that away and lower rates. So broaden the base, lower the rates, and that will just be better. Economists think it's more efficient. It's easier to administer. You don't need as many lawyers at the IRS. But that is really hard for the reason Aruna said, because everyone who's benefiting is benefiting a lot, and the effect of generally lowering rates is kind of diffuse. So it's very difficult to do.
Well, and there are certain things that are in the code that are there not just for business reasons, but I can think of things that could be on the table of tax reform. I'm from Houston. Hurricane Harvey was a major disaster in Houston, and a lot of the people in Houston are going to need certain deductions related to writing off the destruction and the disaster that they had related to the hurricane. And those things are important, and that's one way that the government, through the tax code, might be able to help its population right? As opposed to direct government spending.
That is exactly right. I think, and this is an important point, that how you ultimately tax reform comes down to just values. You know, there's often not a right answer for any of these. I mean, these you could have direct payments to people hurt by the hurricane, and there will be some, or you could do through the tax code, and you give up other things. So a lot of government is just about, you know, what you know, there's only so much the data can tell you, although it can direct you. But a lot comes down to what kind of a society do we want?
I mean, you think about just, you know, to go specifically to what Caroline's saying here, you know, you think about just remediation or cleanup costs. You know, you could do it exactly how Jeff just mentioned. You know, we could pay FEMA to come to everybody's house and clean up your stuff. FEMA would have to be a really big organization and closely affiliated and tied in with your local municipal waste areas and hazardous waste and things like that. Or you kind of know where your stuff is, you know how much it costs. You take on those cleanup costs for your own home. And rather than the government plus up the funding for FEMA, we'll say, thank you for taking care of it. We're going to help you. You're making your community better, and you're making our country better for doing that. There are certain things that are handled far better at the level of the individual.
Okay, I hear you and I understand that, but I constantly hear in the tax press, and I hear just on the pages, the editorial pages of the Wall Street Journal, and I was just at an event yesterday at the museum, that tax reform is still really important, and it's something that we really need to do, and lowering rates is a big part of that discussion. Why is it so important, and why is it such a priority right now?
Let me raise one of the arguments that's sort of, it's often raised in a variety of ways, a lot of times depending on the audience. So we'll kind of first start with the corporate rate. You know, you'll hear argued that the United States is extraordinarily uncompetitive because our statutory rate is 35%, the highest in the developed world, I think now, or is there one country higher? It might be like, you know,
Top 3.
I think Japan was higher and then just dropped, so it's top 3, is that right?
We are the highest at this point.
We are the highest. We're number 1.
Yeah. Thanks,
but-
Japan.
Yes, great. So there's this number, 35%. Do companies normally, and then we went through what Jeff talked about, all of these extraordinary tax expenditures, let alone the ability for large companies to go ahead and locate different operations, income, investments overseas in lower tax jurisdictions in a provision called deferral, which allows you to defer paying tax on income that is earned overseas until you bring it back to the United States. So at the end of the day, 35 is not the right number in terms of what people are paying. Very few companies are at the very top end. So you're looking at, I think today, one of our members mentioned, I think he said 18.8 was the number he used. I've also heard 22. Someone here can probably correct me as to what is the exact, but I think I've given you the rough range of what is the effective corporate rate. And then below that, and you know, you'll have a number of companies that are paying single digits or negative digits. So the competitive argument to me is, the competitiveness argument has always been, to me, a bit of a red herring. Okay, now if you want to talk about increasing efficiencies in the way that the government collects taxes and in the way that entities remit taxes, I'll bite. I'll definitely bite on that one. You know, should it take so? I mean, I think right now there's at least 4 different benefits for education tax savings. Do we need 4? Maybe we could just consolidate them and make it easier. I don't know how many of you guys have started saving, because saving's really important, but there's a lot of ways to save money for retirement. Some are 8.
There are 8 ways to save for retirement.
Yes.
That's been great.
And then there's real special ones too, right? Public teachers, you know, I mean, there's all different, but you know, could we maybe do some consolidation or streamlining there? Yeah, I think you could. So this idea of increasing efficiency, I think makes a lot of sense. Also, people like lower numbers. You know, that's, I mean, in all honesty, the rate's too high, we need to lower that rate. Oh, okay.
What's up, Jeff?
Let me say one thing about corporate tax I think is important, because it is something you hear all the time. and it's true. So everything Aruna said is right. Other things to think about: corporate tax burden, especially because of our international tax system, really varies by type of industry, by type of company. So a company like Walmart that has a lot of people here, you might expect to pay more than a company like Apple. So you might not want that. So the other thing is that corporations do not pay tax. Only you guys pay tax. People pay tax. So the corporate rate is really irrelevant. You could think of if you think that the corporate tax falls on workers, you might think it should be lower. If you think it falls on owners, then you might want to think of other ways to tax wealthy people. I mean, so it's important to think about the argument people make for cutting the corporate tax is jobs. And that's just an empirical economic question. I'm not an economist, so I will not make any pronouncements about that, but it's probably the right goal. And then you should think about how to raise money in a more efficient way that fits your view of progressivity.
Okay, well, I want to hear, Alex, I want to hear what your clients say. Because you talk to these folks. These are people that, you inform them on the process. Do they, and I assume they're banging on your door saying, tell me, am I going to get a lower rate so I can hire more people, hire these people?
Right. Yeah, I mean, I think there's a huge disconnect between corporate tax reform, or maybe business reform, which would include pass-through entities, and individual tax reform. And you'll get a lot of Democrats, moderate Democrats, to agree that the corporate rate is too high. It's the highest in the world, regardless of whether the effective rate after 199 and depreciation and everything else is lower. That's a good argument, and it's true. Most corporations do pay in the mid-20s, probably on average. But we do have a really high headline rate, and I think the argument is that can affect, if you're a brand new business, where are you going to headquarters? Is it going to be in the US or somewhere else? And as Jeff said, the other big issue is our international system, where I think one of 6 developed countries at this point that still taxes resident firms on a worldwide basis. So subject to deferral, and you get a foreign tax credit when you bring money back to the US. But almost every other developed country has moved to a territorial system, where if you're incorporated in that country, you don't pay tax on income earned outside your borders. So those 2 factors are huge, and I think they really unite the business community, that the US is just not like anybody else anymore. Whether you believe it or not, I think it is a competitiveness issue for some firms, for sure.
Okay.
But so there's unanimity on that, and I think Paul Ryan and Chuck Schumer got quite a ways down the road in 2015 of trying to kind of portion off that part of tax reform from the rest of it. Because individual tax reform, the education incentives, the retirement incentives, the itemized deductions, there is so much less agreement on that. And rate reduction, very few Democrats believe that the top individual rate should move. They're kind of fine where it is. They think we litigated that fight with the expiration of the Bush tax cuts. Mm-hmm. But the discussion we're having right now is comprehensive tax reform. So it's corporate, pass-through, individual together. That's really, really hard. That was the style of 86 reform. It was the style of Dave Camp's draft in 2011, 2014. But the politics of that are just so impossible if you yoke individual reform to corporate reform.
Okay, so stepping back just one quick minute. Jeff, can you explain the differences between corporate and pass-through?
Sure. Can I say one thing about international?
Yes.
So maybe everyone here knows this, but so the way our international tax system works is that if you earn active income offshore in other countries, as long as the cash stays offshore, you are not taxed in the US on that. You pay foreign tax, but you're not taxed here. As Alex was saying, most other countries have now gone to a system that exempts that income entirely. So this is why you hear people talk about trapped cash offshore, that's what they're talking about.
Okay.
So corporations pay tax at the corporate level, corporate tax, and then your dividends are taxed when they pay those earnings out. So there are two levels of tax for corporations. Pass-throughs like partnerships or sole proprietorships and a couple other entities, LLCs, which are taxed as partnerships. You only pay tax at individual rates currently. And there is a part of the framework, which I have here and you can find online, is that pass-throughs will pay a lower rate or a rate capped at 25%, which is below the top marginal rate. Exactly what that means is not, the details are not in the framework.
But so part of the tension here from what I'm hearing is that if corporations pay at the 35% rate and individuals who have business ownership in a pass-through structure pay at the higher marginal rates, they're not going to accept a Ryan Schumer proposal to just reform the corporate rate when all of these other individuals who have businesses are paying at the higher marginal rate.
So under CAMP, so what CAMP did was what I described before, like classic, broaden the base, lower the rates. And as Runa said, it was extraordinarily difficult and it did not make everyone happy, I think we can say.
It made very few people happy, maybe one. Chairman Cam.
But the argument there was that he slowed down depreciation of assets, for example. And
what's depreciation?
So you buy something that lasts for more than a year, say you buy a building or you buy a machine, you don't deduct the entire cost in year one.
Right.
Economic value of it.
You
Right.
deduct it over a period of years that currently is faster than we think those things actually depreciate. And so it's accelerated in that way. And so when Chairman Camp's bill was released, I think pass-throughs came in and said, this isn't fair. You are taking away benefits that we have today, and you're more or less using them to pay for a reduced corporate rate. Well, we don't pay the corporate rate, so we feel that we are paying for a lower corporate rate. And I don't know that was the genesis of this lower pass-through rate, but that's one.
Yeah. I think Republicans have made tax reform a little bit harder in two ways in the last few years. And one is this pass-through distinction. I think it was the Kemp draft and probably also these Schumer-Ryan talks where they're talking about corporate-only tax reform. And yes, as Jeff said, the pass-through community really hated that because they said you're broadening our base, but we're not getting the rate reduction. The other area is in depreciation, as Jeff alluded to. Camp would have repealed accelerated tax depreciation to pay for a lower rate. Republicans generally hated it. It doesn't show up good from a growth perspective when JCT puts out their analysis of the plan. So they've moved 180 degrees in the other direction toward full expensing from it in the first year for tax depreciation. That's a monumental shift. So that change and this new lower rate kind of bringing it all the way down to the corporate rate or somewhere between the corporate rate and the individual rate, those are expensive changes. And it just makes the base broadening discussion that much harder if you have to have it be revenue neutral to move it under reconciliation.
And
so
base broadening means eliminating tax
right.
preferences and incentives across the board for both individuals. So it's not like just corporations would be impacted. And that's a good segue into the Trump framework, which says we're going to lower the corporate tax rate from 35% to 20%. And then we're going to have individuals with businesses, they're going to have this lower rate of 25%. But we're covering individuals too. We are going to allow for there to be lower tax rates across the board for individuals. We're going to take the existing tax brackets. There are 7 of them. They're kind of confusing. We're going to collapse those down to 3. So everybody wins, right?
I'll set up Jennifer here. So expensing, the effective expensing is that there is a 0% rate on your return from that asset. And Jennifer can explain how that works with retirement.
Okay, well, and other things, because I can talk about healthcare, because that's another thing too. Well, and actually, I'm just going to cut to the chase and say, I'm the person that they're going to, or I represent the person that where they're going to get all the money to pay for these things.
Yeah, I'm screwed too.
Yeah.
Left, right, up, and down.
Because no one cares about retirement. I mean, how many of you in here have thought about saving for retirement? Yeah, that's a good showing. So, we have retirement savings in this country. Well, first off, let's talk about Social Security, because that's the first heavy hitting thing. So I think my fiance does the best job ever of explaining the federal government. We are running an insurance company with a military. Social Security is an incredibly expensive line item on our budget, but it is literally the backbone of our society. If we cut Social Security, we will literally be putting people back on the streets because the people that are actually using Social Security and depending on it need it the most. And so we have that. That's one part of retirement. That's literally the bottom. I mean, people that are getting retirement benefits exclusively from Social Security, you're getting about $19,000 a year, $20,000 a year. I really want to see you live off of that in most places in America. It's a challenge, let me tell you. So you have to then save more on top of that. And there's 8 different ways in the tax code to do that. And companies can do it and help you do it for you through a defined benefit pension, which don't really exist anymore except for 2 people at this table still have one, maybe 3. Yeah, Alex. And that is one way that a company can provide you with benefits through a very hefty helping on their tax benefits, but also to yours, into your pockets. I mean, then we have 401ks, IRAs, those kind of things. We can get into all kinds of various letter soup. But what is happening, and one of the big ideas that has come out recently, and scary for those of us that work in the retirement world, how retirement mostly works right now in America is you do not pay taxes on your retirement savings when an employer offers it to you. So you go to Deloitte, you go to KPMG, you go to anyone, and they have a 401k or an IRA plan, traditional IRA, I'm going to caveat in, and they tell you, okay, we're going to match X number percentage of your paycheck and put it into your retirement account. Well, you don't pay tax on that money going in. You only pay tax on it leaving you after age 59 and a half, probably 62 to 65 in today's society. And so one of the big proposals that had come out, and you'll hear in the tax press and everywhere else, is called Rothification, which basically means they want to tax that money now. So you'll pay tax on it now, not later. And that helps bolster it helps pay for things now and today and helps do things potentially like shore up Social Security. Why that is bad for you today and most of us today is because you're probably making more money today, even when you're 25 and 28 and 35, than you're going to be at age 65. And so you'll pay less tax on it at the back end than you are paying now and today. This scheme really only works for people like Mitt Romney. And if you want to nerd out for a little while, you should really read about Mitt Romney's IRA, and you'll understand what I am talking about a lot better. So, but retirement.
They are equivalent, though.
What?
They are equivalent.
They're equivalent. They're not the same thing, but it's a really great teachable concept that most people can go, okay, I get this now.
But wouldn't it also have the incentive of disincentivizing an entire generation from saving for retirement because you're making it more expensive?
Correct. And we already have
to get lower taxes.
But so we have this problem with Social Security that I'm sure you've heard of, that Social Security won't be fully funded or pay out a full benefit after, is it 2028, 2033? They keep messing with the number. I haven't read the latest report recently.
17 years, I think.
Yeah, so if they do nothing, if Congress does absolutely nothing, Social Security will only be able to pay 70% of the benefits that people pay into it. So you're going to already have a reduction in benefits on your backbone, your foundation of retirement savings. So if you're not saving on top of that, and we don't give you any purpose for doing it, and in the code right now, we give you the tax deferred savings. We also, if you are of lower incomes or a moderate income family with potentially children, we also give you tax credits to also save for retirement, so to help incentivize you to do so. So there are all kinds of things that could potentially go away if we don't, pay attention to them. And unfortunately, people saving for retirement is not a high priority, even to people that I talk to all the time on the Hill.
It's hard. I mean, I'll be honest. When I first started working on Capitol Hill, I was making $25,000 a year, which isn't a lot of money to live in DC in a group house with 4 other roommates, kind of crappy group house, whatever. Someone had a dog, they never cleaned the carpets. The rent was pretty high. And the one thing I love to call my financial advisor is my dad. He was like, you're getting a good match, start saving. And I think I started putting away, it was 10% or something like that. 10% of 25,000 brings my income to 22,500. So that is literally, it's a lot of money when you're young, but
could use the saver's credit. Sorry.
But literally it's like that incentive changes so much where I am now. Years later.
Okay, but Natalie, do you have any data on how people feel about tax reform, specifically at AU?
Yeah, absolutely.
Or retirement savings. Do we ask about retirement savings? I can't remember.
No, we asked about what people think will contribute most to the debt, or if they'd be okay with having a tax increase to finance that.
I want to know about that, because that would indicate that these folks might be more okay with higher taxes.
So what was really interesting was one of the questions that I asked in my survey that I put out to a bunch of AU students was, would you be okay with having your taxes increased in order to finance the debt? And I think it was 80% of people said only 5% or not at all. So there's this really interesting notion behind millennials wanting bigger government services but not wanting to pay for it, because as soon as taxes are mentioned, they completely revert and want smaller government services. So I think that's an interesting point of conversation.
I think it is too. Do you save for retirement?
Yeah, I do.
Is that something that you talk about with your friends?
Yeah, actually, one of my friends started a retirement plan because of me.
That's fantastic.
She's like, Natalie, I just came home.
work.
I just put $100 to my retirement account. I'm like, great job, Alex.
Would it impact you if they eliminated tax incentives for you to be able to save for your retirement?
Absolutely. I think what's really important, though, is that you start planning now, because if you start later, it's so easy to push it off, and you'll wake up one day and you're about to retire and you're like, oh crap, I don't have all this money saved that I need. And also, we don't know where we're going to be 50 years from now. We don't know what the government's going to be like. We don't know what technology, what society is going to be like. So it's just important that you plan ahead and that you're prepared for whatever might happen.
And those are good points, but in the meantime, you got to pay off your student loans. And did the Trump framework, Aruna, I can't remember, did they talk specifically about student loans or education incentives, things that would impact this crowd right here?
There is very, very little specificity in either the Republican blueprint, the April one-pager document, or this new framework. There's always been talk about retaining benefits for education, but also eliminating a number of deductions, both itemized and above the line. So you really don't know. And if I could add one thing onto this Rothification conversation real quick. This idea of, don't worry guys, you won't be taxed now. We're going to, or it's like, we'll tax you now, but we're not going to tax you later.
Yeah.
Do any of you guys trust the government, if they're in a dire strait, to not raise taxes by taxing you on both ends? I didn't think so. It's a legitimate concern. If the deficits are looking the way that they are, we change rules every 5 minutes, it feels like,
That is definitely a political concern, but I think that if you earn $1,000 today and you put it in a traditional, which means you can deduct it, so you get to put the entire 1,000 in, assuming that your tax rate today and your tax rate at the end is the same, I think it's equivalent to having $1,000 taxed at 25% and investing $750, assuming the government doesn't tax it.
I'm going to burst your bubble and say the likelihood of having the same tax rate is just not going to happen. And that's why, because you're going to have less income in retirement.
And the time value of money, right?
Yeah.
But no. No, I don't think so.
Oh, you don't think so?
I do think it's because the government is in effect kind of investing along with you.
I will say just one point, and I think the odds of this happening, the saving grace here, are very low. One, it's highly controversial, and two, I can put on my budget nerd hat again. This is really just a blatant budget gimmick where you're pulling revenue forward from the future to pay for current tax cuts. Let's come back to the Byrd Rule in the Senate. You can't have long-run deficit increases, so you can't pay for permanent rate reductions with pay-fors that go away later or that raise less later.
Yeah, but you could pay for a 9-year rate reduction. And who's gonna come back in year 10 and say, don't worry guys, we're just gonna let your corporate rates go right back up. I mean, I am not as comfortable as Alex is that this is something that's off the table.
Oh,
I think the world is wide open in terms of what is in play.
And I think that there's, well, first off, I'm going to burst the bubble of this. I mean, I completely agree it's a budget gimmick, and I will tell you why. The median retirement savings account has $2,500 in it for individuals who are aged 25 to 64 in this country. So we're really talking about a Rothification, like $2,500. And I think that in between 59 and 64, 55 and 64, that value only raises to about $55,000 or somewhere in the 50s. And so really we're talking about low values for a majority of the population. So this really is a budget gimmick and that we're talking about. So when you actually put this in real people numbers, you know, and we talk about Rothification in theory or $1,000 here and $1,000 there, and not to hate on your $1,000, but when you're talking about a majority of the population that has $2,500 saved for retirement outside of Social Security, you know, a Rothification style thing really doesn't matter. We should just really encourage people to save more. Otherwise, they're going to be wholly reliant upon Social Security, which we already have a problem funding.
I mean, if it's really that low, that's actually shocking. I did not know that.
Oh, I'll send you the report.
but that does suggest that it's generally wealthy people who will be hit by Rothification.
It is, well, and
it is definitely a budget gimmick. There's no question about that.
Very much so. Something that I will say, there had been student loan, Trump put out some student loan proposals during his campaign, especially for people that use public service loan forgiveness. There has been some discussion about that. But, you know, I would love to see more details about these things. These are the things that people, you know, really want to know about: student loans and healthcare. You know, we're not really talking about the largest expenditure, but outside of Social Security, you know, the largest tax expense is not taxing healthcare. You know, when your employer provides you healthcare, you're not taxed on that benefit. That is the largest line item giveaway that we have, and that's the one that I'm kind of shocked that hasn't crept up yet.
Can I just take that comment and put it into sort of a bigger perspective? This is probably the most bothersome part of everything that's going on right now. Okay, the fact that there has not been a thorough vetting or even the presentation of a comprehensive proposal in legislative language. If you look, I mean...
Wait, is that supposed to happen?
It's
No, I mean, describe how it happened in '86.
Okay, just for the record, I was 8. I was not at the committee then, but I've gone through and looked at it. So, you know, we were just talking briefly before. Of course, now I'm going to forget the numbers, but the exact number of hearings that they had. I can tell you it's...
Brent.
Brent probably knows that.
Yeah,
how many hearings did they have in '86?
I've got to be at least 100 in each chamber.
So 100 in the Senate and 100
in the House. I can tell you, though, that the list of witnesses in the House, single-spaced, 12-point font, is 44 pages long. Okay, that is all the stakeholders that came and testified.
testified.
And then, and
Didn't
you
just
know,
write comments.
exactly.
Didn't answer, click a link and write a comment. They came in and testified before members in a hearing.
And you guys, even if you submitted comments back then, you had to walk over to the Longworth building and submit them. You can't just email them in and whatever. I really don't like that. That's garbage. Boom. That's not a valid comment. But I mean, I think it's, I'm not trying to be flippant, but this stuff seriously matters, okay? And especially when you don't know at all what your trade-offs are, and all you keep hearing is, don't worry, the middle class is going to be fine. I mean, I'm at this point now where I just want to start proclaiming that, you guys know this bill includes a tax on happiness? People are like, no, it doesn't. I just want to be like, prove it. Put out the damn bill. Let us see that it doesn't tax happiness. Let us also see what it does to state and local taxes, what it does to employer-provided health care, what it does, whether we're doing a net massive, I mean, after this most recent election, people always refer to this Ryan Schumer deal as sort of like, well, that's kind of like a lowest common denominator. What if you could get that? I do not see how, after you have a populist election like the one that we just saw, the American public is going to be okay with a tax cut for multinational corporations. Just that, we got it. Or even just businesses and multinational corporations. Or even just pass-throughs and corporations and multinational corporations. Because you still haven't done anything for actual people. And there's all these assertions coming out, you're going to be fine, that person's going to be fine. Their rate isn't going to go up.
We can do it on a postcard.
We can do it on a postcard, at which point I'm just like, you need an envelope. It's all your vital information's on there. You don't want that just out there. It's a postcard with an envelope, Social Security numbers on there. Come on, And even, in some ways, this idea of collapsing the 7 brackets, You guys, I assume many of you have done your own taxes, right? You all know that those 7 brackets, they mean nothing. Even, up until not that long ago, I used to do my taxes with a pen and a paper. And you just figure out your number, and then you go look at the table, and that's your number. Mm-hmm. All right? That is a calculation that's done behind the scenes. Everyone's like, oh, my God, 7 to 3. We're going to go from 7 to 3 without even, calling that simplification. And, this stuff, I think back to the camp plan, when the original proposal was to have 2 rates, 10 and 25. All right? Pretty dramatic rate reductions over there. At the end of the day, the draft comes out. There's a 10% bracket, a 25% bracket, and then there's a 10% surcharge on certain types of income for upper income people. And I talked to someone who's actually a current colleague of Alex's now, and I asked him, why'd you guys do it? You spent 3 years saying 10 and 25, 10 and 25. And at the end of the day, they said, this colleague said, Aruna, it wasn't hard to get me down to 25, and it wasn't hard to get you down to 25. But it's really hard to pay for Oprah to get a tax cut to 25. But to which I responded, did we ever even have the conversation as to whether or not we think Oprah needs a tax cut? All of those questions matter, Why'd you even worry about it? Should we have been concerned with making sure Oprah gets 25? I love Oprah, so don't, she's golden, But at the end of the day, all those things matter. And right now, I have somewhat deep anxiety that in 3 weeks, we will get a chairman's mark, which is not a comprehensive bill. I'm thinking lots of cheesecake, spinach comes out later, and we'll have somewhere between 3 or 4 days to read legislation that's over 1,000 pages. And for everyone in America to read legislation that's over 1,000 pages. And then we'll consider it, and that's it. This is not the way this government should work. And literally, everyone kept saying that healthcare could impact 12.5% of the economy. This is literally 100% of the economy, and we don't know what's in it. It is a terrifying prospect from my perspective.
It's probably particularly terrifying for you because you have such a close proximate relationship to it, and it could happen that way in the House. But thankfully, I think the Senate is the graveyard for so much stuff that comes out of the House.
It all dies there.
And, you can't help but feel that this could play out again unless ambitions in the House and Senate are vastly scaled back to something more achievable. I don't know what that is exactly. For the reason that Aruna said, the only thing that unites people at all across parties is probably the corporate rate's too high and the international system is all messed up. But the political optics of doing that in this populist environment, it's going nowhere. So I just see dead ends everywhere. But you just think about a bill that is as ambitious on some of this stuff as Aruna points out it could be. But then you have folks like John McCain and Bob Corker in the Senate who are really, really disgusted with the way Senate procedure has been so far this Congress. I mean, you saw it on healthcare. You know, John McCain basically voted no twice on healthcare just to flip the bird at, reconciliation. It hadn't been vetted. He didn't think the policy needed to go through regular order with the hearings that, folks are talking about. So, I'm not trying to say nothing is going to happen, but the Senate is a good buffer here to stop a really bad bill.
I don't know if you've heard this analogy, but like the Senate or the House is like your steaming hot cup of tea, and the Senate is the saucer that cools it. In some ways there is thought of that, but I will be honest, this is, time is getting short and legislative victories have been extraordinarily few. And so I would not underestimate the will to do something. And especially when you are short on time and high on will, you get really bad bills put together, like really bad ones that just are slammed together and then they go. So that's second biggest fear, I guess. But that's always valid. I mean, the speaker just announced today, we're staying in through Christmas until tax reform is done.
So, okay, if there could be a lesser bill, and we're taking wholesale reform of the code off the table, it could just be a tax cut. Going back to the process question, if it's just a tax cut, does it have to be under reconciliation? Can it be done under normal rules of procedure and add to the deficit and that's fine?
There's so many cross-cutting factors. I mean, it probably has to be done under reconciliation because you're not going to find too many Democrats that are going to be too gung-ho about just adding more debt to the debt that Natalie spoke of. If it's truly targeted at the middle class, there's probably hope for something to move outside of reconciliation and get 60 votes in the Senate, break a filibuster, just do it that way. But we're at the point now where I just don't know what Democrats would do with Donald Trump. I think that's the risk they're running, that I don't know what's achievable anymore.
I mean, I think back to the 2001 tax cuts. That was the first bill I worked on the committee. So in 2001, okay, the bill cost $1.3 trillion. If you inflation index that, you're up at around $1.8 trillion. Round that up to 2, whatever. So $2 trillion. That was a bipartisan bill in 2001. Now, remembering we were in a totally different budget position then.
We had a surplus.
We had a surplus. We had a couple of years of surpluses. And people thought our surpluses were getting too great. So they said we have to spend them now. And so these dollars went out. But I still come back. So even if you say 1.82 trillion, bipartisan, indexing that, you could do it. But I always still come back to, so now you have a $1.8 trillion bucket. Who gets in? Cutting the corporate rate, about 1.5 trillion. That's most of the bucket. All right. We haven't done anything for pass-throughs, the multinational stuff. We still haven't done anything for people. So this bucket is limited. And I do think you could do a modest bipartisan tax cut, but I don't know who gets in, where you get the agreement on who gets in.
And the other huge challenge here, and this is so depressing, right? There's just like roadblocks everywhere, but it is true that north of 40% of households don't pay federal income tax. They pay all kinds of other taxes, payroll tax, state and local tax, gas tax, whatever. But if you have nearly half of households not paying federal income tax, how do you even cut their taxes? You either have to cut their Social Security or Medicare taxes. You can't cut Social Security under reconciliation, under the rules of reconciliation. Or you're dealing with refundable credits like the Earned Income Tax Credit, or part of the child tax credit is refundable. Republicans generally aren't nuts about refundable tax credits. So again, we get back to this, who gets in and how do you get a tax cut to a population when the answer is refundable tax credits that Republicans don't really like.
Okay, all right. We have some questions. Does someone want to have any questions? Because I still have plenty more. But does anyone have any questions for the panelists? Yes, go ahead.
I have a question. And so what is the tax reform impact on the sorry. That's fine. Yeah, so what is the tax reform effect on the unitary business group, which that they filed, like, for example, consolidated federal return or combined federal return?
What could it be?
I
mean,
I'm not good with the return.
Well, so generally, I mean, those you're talking about large U.S. multinationals. So they're the two biggest items that, and Alex already said this, but corporations want a corporate rate cut and they want a territorial international tax system. Those are by far the biggest requests out there, and they are both hugely expensive, as Aruna said. But those are more than anything else. That's what they hope to get out of tax reform.
Hey, Alex, along those lines, do you think that there would be a change in the hiring for, say, accountants, Big Four firms, if we were to just lower the corporate rate and eliminate all the other tax provisions that corporations rely on under current law to lower their rates?
I don't know. It really depends on, the trade-off between the dessert and the vegetables. Deloitte is actually a partnership, so we would not benefit from a corporate rate. Discussions of lowering the pass-through rate surely will not include Deloitte partners.
Right.
So I don't know. It depends on that trade-off.
I mean, you have to go ahead and explicitly carve out service partnerships. Now that's been discussed, but let's talk about, Alex is right, Deloitte probably shouldn't. My sister is a small business that she started in June. Mm-hmm. She does a clinical psychotherapy practice, just started. She has 8 clients. Pretty sure she should get that lower rate. It would probably be good for her. She's a service provider. She's not treated the same way that your large accounting firms are and large law firms are. Is that the right answer? I don't know. I don't think it is.
Right. So the key comparison is between Aruna's sister and psychologists who work for American, who get wages, who get a W-2. Her sister doesn't. You want what's called horizontal equity. You want people who are doing the same things to be taxed in the same way, and so. But it's a fair point.
Yeah.
Yes.
Thank you. As a student, I just want to know how much this tax return reform will impact the student loan right now.
So that's a good question. I mean, without knowing any specifics in terms of what they're going to do with the student loan interest deductions and things like that, unfortunately, I mean, the idea of broaden the base and lower the rate means we get rid of everything. You don't need a preference if your rate is low enough. There's a secondary question here, but unfortunately, again, the details are simply not out there. There's a secondary question here, though. If you have a bill that is adding $2.4 trillion to the deficit as scored right now, that money's going to have to come from somewhere. Now, that could be coming from Pell Grants, that could be coming from Social Security, that could be coming from Medicare, that could be coming from defense, not likely. No. So you kind of know, it's this idea of, oh my gosh, big fat tax cut. Wow, look at these deficits. Oh God, we have to cut all these other things. There are very important ramifications even down the line that we have to look at of where other programs are going to go away. And at this point, there is the American Opportunity Tax Credit, which I think is generally the most generous tax credit out there right now. Mm-hmm. There have been proposals to modify it. Everything that I have seen so far has talked about retaining that tax credit. But again, prove it.
So that's a tax credit that's about, what, $1,000, maybe $2,000 a credit for qualified tuition expenses. But the student loan interest deduction is only for $2,500.
Up to a certain income level.
Up to $65,000 a year.
Yeah.
So it's a very limited tax. It's a very limited tax benefit, and I know that from my own personal experience, I had loans in excess of $100,000. I had paid interest in excess of $2,500 a year and was never able to claim that interest deduction under circumstances because of my income, which maybe I'm a person that maybe Congress made a concerted decision that if you're in a higher income rate, that's fine. But there's no guarantees, at least in the framework language now, that even that limited deduction of $2,500 for student interest loans would be retained.
That's right.
And I also want to mention something. Places like Deloitte and KPMG have really looked at the idea of being good companies to their employees and potentially helping pay back student loans. And if anything and everything is supposedly on the table right now, one of the great things that we should be fixing in this process is companies like Deloitte can't actually do that. They can't actually give you, pay your check to, they can, it's just not tax favorable for them to do so. They can't pay a check directly to your student loan servicer. So they're finding other creative ways to do it, putting in a match into your 401k. But if we want to incentivize, lower or decrease student loan debt in this country, and we have these companies that want to do this, this is a really good idea. If everything is on the table, shouldn't something like this be on the table? Because this is small peanuts compared to the big peanuts.
This idea sort of in this exercise, or what are the sort of the notion of this being a lost opportunity? Because you mentioned, we're talking corporate pass through, individual. I would add the estate tax to that list, which is something else. Repeal the estate tax. But the one thing that I understand is not being considered are excise taxes. So I'm sure all of you guys have, or not all of you, but raise your hand if you've popped a tire on a street in DC. Okay, so the number of you that know that our roads and bridges and stuff are in pretty terrible condition. We pay money via the gas tax to make sure there's funding, to make sure those are okay. Wouldn't this be a nice time to maybe take care of shoring up that type of spending off the table? So you talk about this, tax reform that happens once in a generation, that lasts a generation. Are we really mostly focusing on multinationals? Is that what we're doing here? So there's this bigger question.
Yeah, I think,
Go ahead.
Sorry. That is a good point, that if something happens in the next year or month, there's a real risk that it's not sustainable, that it may have to be clawed back later. Because when you look at the decisions around Social Security and Medicare, everything left in the federal budget to cut is a third rail, and it's probably not going to happen. So if we do revenue losing tax reform, even if we do revenue neutral tax reform, there is going to come a day when the piper has to be paid. And we have high rates applied to a narrow base, so we don't raise much through our income tax. Jeff mentioned this at the outset. Most people will tell you the elephant in the room is some type of other revenue source. So for people like us, I do think maybe not 5 years, but 10 or 15 years down the road, it's probably a VAT or a carbon tax. At some point, it becomes an inevitability to stave off a debt crisis and interest rates going through the roof, et cetera. It's a scary thought, but I think most people who look at this in a sober way think it's coming.
But do they know it's coming? Natalie, what does your data say about AU students and what they think about this looming crisis on the debt and deficit?
Well, a lot of them didn't really know or don't really see it as a pressing issue. From what I recall, most people on average, when asked about how important fixing the debt was to them, responded 6.2. So on a scale of 1 to 10. So they see it as a somewhat pressing issue, but it's not the most important issue that we should be looking at. However, as I would argue, it is important to address it right now because the increase in mandatory spending is going to start squeezing at the discretionary spending, and we're not going to have any funding for things like children education programs.
And what's mandatory spending again?
So that's the funding that the government is obligated to pay. So Social Security, Medicare, Medicaid, those are all things that we set out to pay every single year, and that we're required to pay first. Those are our liabilities. And so things like children education programs come second, even though that they're incredibly important. I think it's the Urban Institute said that by as early as 2019, funding for children's education could be completely cut. So this is something that's coming fast, and without saving for a retirement plan within the blink of an eye, we could just not have funding for children's education.
And can I just, something that happened in the Ways and Means Committee, this happened 2 years ago. And this is probably one of the most appalling things I ever saw. So remember, when you eliminate the estate tax, that only impacts estates that are over $11 million. So north of, you have to get above there to even face a dime of tax. We had a provision that was under consideration in the committee. It applied to helping foster youth who are transitioning out of the foster system when they turn 18. It helped them collect their documentation. A lot of times, and things like a birth certificate, helping them to get a driver's license, helping them sort of take that next step to becoming a productive member of society. This provision cost $12 million. That is, in the world of the federal government, chump change. And the majority demanded an offset. We have to pay for that. Eliminating $262 billion of wealth transfer tax is free, but $12 million for the children in our country that don't have parents, where literally the country is we are their parents because they don't have them. We have to pay for that. So I think you have to, it's a bit of this, remembering what our priorities are too, and what's coming out. And unfortunately, we don't exactly know what's in this bill yet to figure out where this legislation is going to place these priorities.
Okay, so I have a question about that, but I want to ask, does anyone else in the audience have questions? Okay.
Oh boy.
Maddie, what's your question?
Mine's pretty brief. You guys talked about the discrepancies between marginal and effective tax rates in the United States and how a lot of corporations are really only paying in the mid-20s. Do you also see that discrepancy in other developed nations that have a lower marginal tax rate? Are they also paying an effective tax rate that's much lower than their marginal rates?
That's a great
Yeah.
question.
Yeah.
I think
that we're here and not talking to the guy who is actually responsible for conducting that research right now. I will ask for Maddie and I will answer that in class. I don't know off the top of my head, and I should.
There's a chart online about this on the OECD
On the OECD
list.
chart.
And it's they have it, I've seen it. I wish I had had as good of a photographic memory. But yeah, it actually says the one tax rate and the effective tax rate. I think we're 6th with the effective tax rate, but that could have been old.
But one thing, Her Majesty's Treasury, a bunch of people from the UK came to come brief us when they reduced their corporate tax rate back in, this was maybe 2009, 2008, 9, 10, 11, right around there. Okay, and they did a pretty serious corporate rate reduction. And they talked about the benefits, how much more investment they drew. And when you finally asked them, so how'd you pay for it? And they did say they did a very small amount of base broadening, and they increased their VAT.
Mm-hmm.
Okay, so it's not even a matter of eliminating the preferences. We just dial up the other sucker, and we collect that revenue.
Next question.
So I was watching C-SPAN about a month ago. It was about dealing with the Ways and Means Committee. And one of the things that, I forget this congressman's name, I'm drawing a blank, but he mentioned that one of the reasons why corporations have been able to get away from paying the tax rate or paying a negative is because they're taking advantages of opportunities that a lot of pass-through entities, that were reserved for pass-through entities, corporations are taking advantage of. So the questions I have, so wouldn't it be, I think, beneficial to really help balance things out, make sure corporations don't take advantage of stuff that's reserved for other entities? Or
So this always sort of comes back to there are certain benefits that apply depending on what entity choice you make. And one of the reasons why Deloitte and some of the other big 4 accounting firms are so good and successful is because you have very smart people who will always figure out a way to get exactly around some of those rules.
Sounds like a check the box election.
It is. I think you're right, but I will tell you the sort of flip side of this. This idea of reducing the pass-through rate to 25%. The problem with that is now you have sort of income, because you're taxed the individual, as an individual rate. We want to say your pass-through business income should be taxed at 25%. But the wages you would pay yourself from that, your own small business, your own pass-through company, you should really be paying ordinary rates on that. And on your wages, you pay FICA taxes too, which is your 6.2 Social Security, 1.45 is your individual share of Medicare, right? Double that if you're obviously sole proper or whatever. Right now, there are incentives. Imagine right now you don't have a differential in what you'd pay your pass-through income and your wage income as a small business. That's right now it's the same number. And there's still an incentive to recharacterize more of it as pass-through and less as wage to avoid, basically, it's the Medicare tax. That's 2.9%. That's nothing. When you're talking about a big rate differential, you're going to drive behavior into doing things, into declaring, making certain declarations or making certain choices that don't have economic rationale or really doing a recharacterization or mischaracterization of what the structure of the entity actually is or what the structure of the business is. It's very hard. Now, how do you protect that? You put tight guardrails around. You say only exactly this specific type of income counts. Only this. But when you put these sort of types of rules up, people have to comply with it. All of a sudden they get upset because their income doesn't count, or they get upset because the rules have to be that they have to comply with are all of a sudden kind of onerous. You have to show documentation that this investment was directly attributable to this, and exactly what percentage of your home office was used for this. And if you share an iPhone for your work and your personal, divide that up, and things like that. They can get difficult. But that's how you say, well, we really only want this to apply to your business income. But now prove it that's all your business income. It's this is one reason why, if you look it up, there's the National Federation of Independent Business has been quite quiet on a lot of these proposals, because I think generally there's while they do support a lower overall individual rates, I don't know that they trust Congress to write pass-through rules that'll be better for their companies.
Yes.
Actually, I have a question. I know the American government will reduce the corporate taxes for individual owners or some ordinary companies. However, it's related to nationalities or entities, say for foreign companies, if they want to open a branch in America, they also share the benefits or not?
Yeah, I think the short answer is yes, although there are rules today. So we have what are called outbound rules for companies that have their headquarters here and that have subsidiaries abroad, and then there are rules for foreign companies that have subsidiaries here, and that's called inbound. And you may well see new rules that certainly those companies, when Toyota or whoever else is here making cars, the same rules apply to them that apply to, GE and GMC and their competitors. But you may well see new inbound rules as well. For example, about so-called earning stripping, so payments of interest from the U.S. deducted in the U.S. to the home company, so the home country. So you may well see new rules about that.
We have time for a couple more questions. Yes.
I have a question about the disaster relief programs. So obviously 2017 has been horrible. I feel like there's always so many, like a new disaster every day. So where is this money how is this being allocated? Where is this actually going?
Sure. So the legislation passed and was signed into law like 2 weeks ago, I think. I was on the floor 2 weeks ago. Very, very limited legislation. There were 5 provisions in the bill. So one of them lifted the caps on charitable giving, limitations on how much you can give with respect to this, a certain disaster or whatever. So if you're contributing if you're doing charitable giving with respect to Hurricane Harvey or Irma or Maria, you lift these caps and whatever. The second provision allows you to take money out of your 401k and not face the penalties.
An IRIS.
And IRAs. And then there's certain repayment provisions.
Yeah,
and
you could
things like
either
that.
take a withdrawal or a loan, and it increased the amount that you could either, it upped it from 50 to 100.
$100,000. So remember, this is really good for you if you have $100,000 sitting in a
Again,
401k or an IRA.
we now that does not apply to very many people.
Okay. The third provision allowed you, it modified the rules for casualty deductions. It basically took it above the line and said you can waive this sort of minimum floor or whatever. The fourth provision allowed employers who continued their wages to employees to get a pretty small tax credit. It was topped out at $600 a worker. Could be wrong about that one. 40% of $6,000. It's $2,400 a worker, but maxed out at that. Without respect to whether or not the worker was coming. So employers just doing a good thing. All right. And then the fifth provision was a look back. So for your very low income people, let's say these are people who are receiving the child tax credit or earned income tax credit. Let's say these are really wage dependent credits. The better your income is, the better your credit is. Let's say you're out of a job for the last 4 months of this year. You've only got 8 months of wages for tax year 2017. This says, okay, if you live in this area, you can use your 2016 number to get a bigger bumped up credit, okay? So out of that whole package I just told you, the total package I think cost just over $5 billion. I think 3.9 of it was all that casualty loss stuff. So, excuse me, this wasn't a really robust package, and I kind of think this is more directed at what I like to call immediate recovery. Now, it did nothing for expensing in Houston. It did nothing for environmental remediation. It did nothing to enable or encourage rebuilding or reinvestment. So what I'm working on is something to actually take the next steps of there's recover and then there's rebuild, and some of this includes things like providing new markets tax credits to draw investment into these areas that many of which are now going to be kind of economically difficult to develop areas, or bring in low-income housing tax credit allocations because housing is going to be extraordinarily difficult to bring in. And if you actually provide credits, you'll have syndicators come in and really make an effort to put that housing in. So it's this idea of doing a sort of broader type of rebuilding effort. But the key part of what this bill that we're working on right now is that it is not disaster specific. So I will tell you this: the first bill, Harvey, Maria, Irma, the member of Congress that represents Napa, Sonoma, and Mendocino counties is on my committee, and we passed $5.4 billion 3 weeks ago. That does nothing for them because the wildfires in Northern California were not listed. So it's this idea of if we can make the tax code work, and really this is an idea of how the tax code can work well. This is a cash flow issue. If we can help you take advantage, of taking a deduction that'll just free up some money for you in 1 year that can help you better manage your needs. Some of these things they're not permanent in terms of for an individual, but the provisions would be available for any presidentially declared disaster in the future. If you think back to Hurricane Sandy, they got nothing because of the politics of it. It shouldn't be incumbent on the political party who's governing to decide which victims are valuable enough to get the relief and which ones aren't. And unfortunately, that's where we are right now. Now, remember, this is completely separate and aside from the emergency spending, supplemental spending that the House passed today, and I think it was like $39 billion or $29 billion. So, but this is sort of, I consider this to be the rebuild side of it.
That's all the time we have. I'm so excited that you guys came out. Thank you so much. I'd also like to thank Brent Sabat, who has been an extraordinary member of the Kogod Tax Policy team, who is graduating, and I'm so grateful that you guys did such a great job. Thank you so much to our panelists for coming. They're going to stick around for a few questions and networking. I think the cookies are gone, but grab them while they're still there. Thank you. Thank you so much.
Leave this out.